Before we start analyzing the components of GDP, let's first clarify certain basic concepts such as growth rates and the difference between real and nominal GDP. Let's begin with growth rates. As we mentioned earlier, the absolute GDP number computed by aggregating CGI EX minus IM has no real significant meaning for anyone. It doesn't tell us whether the economy is shrinking or expanding on a year-on-year or month-on-month or quarter-on-quarter basis. What we need to determine are growth rates in order to predict how the central banks or market participants will react. So what do we mean by the growth rate? An example of the annualized growth rate is calculated as shown in the Excel sheet. A simple way to think about the growth of a number is to take the difference between the new value and the old value to determine how much that number has grown. Now, in order to find out the percentage growth, we simply divide the difference by the old value. So now the growth is simply new value minus the old value divided by the old value. Growth rates are also annualized so that we can make fair comparisons. So basically we compare apples with apples and not apples with oranges. We can't compare a quarterly growth rate versus an annualized growth rate. We need to annualize all the rates. So in our example, the growth rate is already an annual number and we need not annualize this. However, if we had a quarterly figure, we would need to annualize this number in order for us to make comparisons. So in order for us to make it annual, we simply multiply the quarterly growth rate by 4 since there are 4 quarters in a year. So let's look at our example here. In 1984, the absolute GDP number in our hypothetical economy was $1,000 million. In 1985, this figure dropped to $800 million. Now, this number on an absolute basis really doesn't tell us much. But if we compare between 1984 and 1985 and we find out the growth rate, we see that the growth rate is the nominal GDP growth rate is negative 20%, which means that in current market prices, the gross domestic product has dropped 20% on a year-on-year basis. Between 1986 and 1985, the gross domestic product has gone up. And between 1987 and 1986, the gross domestic product has increased by another 20%, which is a nominal growth rate. So this figure makes more sense to us and to central banks and market participants than an absolute number. Another concept we should understand is the difference between real and nominal GDP. We know that the components of GDP, which are CIG, EX minus IM, are calculated in current market prices. But since we are interested in comparing the GDP figure on a year-on-year basis, we need to deflate this number, and we will see how deflation is done. We will see in this example that a change in the GDP growth rate can be attributed to 2 factors. One is the changes in the composition of GDP, for example, an increase in consumer spending, or 2, the changes in prices. We will see how these 2 factors contribute to the GDP growth rate, both the changes in composition and the changes in prices. So let's go back to a hypothetical economy, and let's assume that this hypothetical economy sells only one product, which is, say, butter. If the consumption of butter in 1984 was, say, 10 million kilograms, and the price of butter was, say, $10 per kilo, then our total consumption would be $100 million. And hence our nominal GDP would be $100 million in that year's prices. Let's assume in 1985 the consumption increases to 11 million kilograms. However, the price of butter moves up to say $12 per kilo due to a shortage of milk. Now in 1985 our GDP increases due to consumer expenditure increasing to $132 million. Now in 1985 our GDP increases due to an increase in consumer expenditure. So consumers have gone from consuming 10 million kilograms of butter to 11 million kilograms of butter, which is an increase in 10%. So consumer spending has increased in 1985, and our GDP has increased due to an increase in consumer expenditure plus an increase in prices to $132 million, since we are measuring GDP in current market prices. And we see that our growth rate has gone up by 32% between 1984 and 1985. However, we know that this 32% increase in GDP is an illusion and partly due to the 20% increase in the price of butter. Therefore, we need to deflate this number to bring prices back to a base year's price, which is the 1984's prices in our case. Post-deflation, we can see that the real GDP now represents a true picture of growth in our hypothetical economy. We can now see how much of the GDP growth is due to a real increase and what is the nominal increase in GDP. We shall study more about these deflators of GDP in the inflation chapter, specifically the two deflators that are estimated in the quarterly GDP release by the Commerce Department, which are the implicit price deflator and the fixed price deflator. But for now, it's important to understand the difference between real and nominal GDP, as these terms will be used throughout. So the action item for this lesson would be to complete the yellow spaces where we need to compute the real gross domestic product, the nominal growth rate, and the real growth rate. And for the 1984-1985 year, similarly, compute the growth rate, the real GDP, and the real GDP growth rate. For the exercise here, we just need to compute the quarterly growth rate and annualize that. The solution is given in the next worksheet, so you could complete the exercise and check for the solution in the next worksheet. By doing this exercise, you should get familiar with computing the growth rates, quarterly growth rates, and annualized growth rates, and get familiar with the concepts of nominal GDP and real GDP.